So how do the wealthy really avoid taxes and hide their wealth? In this video, I'm going to break down how they actually do it, how it's all completely legal, and some key takeaways that actually, if you're on your way to being wealthy, that you can actually duplicate and implement when it comes to protecting your wealth and tax optimizing your wealth as well, to make sure that HMRC are getting the least of it and you're ultimately protecting your wealth against unprying eyes and creditors. So when we talk about wealthy people in the UK, there's this massive narrative that the wealthy don't pay tax, and in some ways this is true, often because of the likes of Starbucks, Amazon, and all of these large corporates that have complex overseas structures that actually do allow them to pay very, very low, if not no tax on their profits. Take, for instance, Starbucks. The way it works is it's a very clever structure. They've got international subsidiaries that own the intangible property, such as the trademarks, the patents, the logos. And then when a store sells a particular cup of coffee, a proportion of that sale is actually tax deductible, because that goes to repaying the overseas subsidiary in a tax haven the fee that is actually rightly due for that intangible asset. The same is true of their beans or the manufacturing proceeds. For Amazon, they've got all their kind of stock overseas, so it comes through, Luxembourg or Ireland rather than coming from the UK. So there's definitely this narrative that a lot of wealthy people don't pay tax, and it's these large corporates that really drive that, because you can clearly see there the complex but clever structure that's in place that actually does allow these corporates to pay less tax. But for the wealthy person, that's not the same. The same is not true. The first thing we need to talk about is actually what is wealth, because someone with 5 million net assets, well, actually a lot of people would consider them to be extremely wealthy. But actually, when you look at hundreds of millionaires and billionaires, certainly it's a completely different structure and ultimately playing field that's available when it comes to protecting assets or hiding assets and reducing taxes. So one of the first things that wealthy people do is they usually have some kind of trust structure involved, and the main purpose of this is for protection. I talk about trusts all the time because they actually are a great tool for protection. Rather than you directly owning the asset, you don't own the asset. The trust owns the asset, and you can merely benefit from this. You often see Andrew Tate say he's got all of his private jets and homes in trusts which he can benefit from, or overseas companies. And indeed, this is what a lot of people do, because actually, if in this example here, Andrew Tate goes bankrupt, well, actually those are not his assets. He's just a beneficiary, and I'd imagine his children and his brother certainly are also beneficiaries. So actually they can enjoy the income, they can live in those properties rent free and everything else. And this is what a lot of wealthy people do, and they do it well. They certainly have overseas trusts, offshore trusts, and overseas assets. And the good thing about this is it's completely private. A lot of these tax havens, even kind of Jersey, they have very limited reporting that's required when it comes to offshore trusts. If, of course, the settler's UK resident or any of the beneficiaries are UK resident, well, actually then there's usually some kind of UK tax obligation on their income or the assets of the trust. There might be some tax to pay in for that trust in the UK. But where you're actually non-UK resident, you're living somewhere overseas, even Dubai, Romania, wherever you might be, there are very limited reporting, if not zero reporting obligations when it comes to declaring the income of that trust, or even there being an actual record that that trust exists beyond the trust deed, which could be locked up in an office somewhere and not many people know about it. So when it comes to protecting assets, trusts are one of the best ways, one of the best tools that the wealthy implement to actually protect their wealth. And of course, if you are looking at offshore trusts, they do have some tax benefits as well. But as soon as you've got a UK resident beneficiary, so even if you set up a trust where you've got offshore assets, offshore trusts, if you can benefit from that whilst you're living in the UK, there's actually a pretty heavy tax bill to pay for you being able to benefit from the income from that trust. And then we touched on this, the likes of Starbucks. The wealthy people, the wealthy entrepreneur has a complex group structure. Not to say that yours has to be complex, but the principles remain the same. So you have a group structure to allow for tax efficiency, whether that's a UK-based subsidiary that owns your intellectual property, or an overseas-based subsidiary. Having that group structure in place allows for these various tax benefits, being able to move properties between groups tax-free, reinvest dividends from a trading company, or sell a trading company tax-free. All of these reliefs and exemptions, these are available to your ordinary kind of not necessarily wealthy entrepreneur, but somebody who's just early stages on their way to becoming wealthy. These tricks, these strategies are available to you right now. They're not just reserved for the wealthy. Of course, everyone plays from the same playbook, just some people know it better than others. And having a group structure is one of those quick, easy, and relatively straightforward wins that you can get set up. Of course, we touched on Starbucks there and how how they can have their intellectual property and all of these kind of complex companies in overseas locations. And you're probably thinking, well, hang on a minute, why can't I do that? Why can't I live in the UK and set up a company in Panama, Bermuda, Dubai, where actually there's lower tax than the UK? And the reason for this is relatively straightforward. It's all about economic substance, central management and control. They're the kind of technical terms you need to be looking at. And for Starbucks, they're a $1 billion organization. They've got systems, they've got staff. So they can actually afford to say, you know what, we're going to have this office in this overseas tax haven. It's going to cost us £5 million to staff that, to kit that out, and actually be able to prove that there's economic substance taking place there. We can have Starbucks head of intangible property living in that jurisdiction. Then actually it's not run by the US head office, and it's certainly not run by the shareholders because obviously it's a public company with lots of different shareholders. Whereas for people in the UK, you can't do that because the chances are you own your company outright. You're probably one of few directors, one of few shareholders. So for you to actually set up a company overseas, one, you need to be making tens of £1 million a year in profit for the tax savings to outweigh what it would cost to genuinely get that commercial operation set up. And then if you're not doing that, well, actually you can't do that because HMRC will just deem you to be running that company from the UK as your tax resident here. So it's all about actually there's different levels to wealth. And if you do have tens or hundreds or even billions, well, actually you can afford to invest more to make your tax structuring that bit more tax efficient. You can have those overseas subsidiaries. Whereas the people in the UK, you can't, simply because you've not got access to that yet. You've not got those economies of scale. So you can't afford to have a head of IP paying them $500,000 a year to basically sit in an office all day and not do much. Another fantastic strategy that the wealthy use to ultimately reduce their tax bill is they do exploit their non-residence tax rules. So we've got a great example. This is probably one of the first examples that I heard. I'm not even sure how old I was. I'm probably 10 years old at the time, but I do remember reading about it in the news, whether that was in my business studies class, about Philip Green's wife. Her name's Tina. I've got it written down here. Actually, she, Philip Green, he was doing a lot of bad things as well with a pension scheme. We won't go into that, but ultimately he's a very wealthy and relatively successful UK business owner. I think he owned British Homes Group or BHS or whatever it was, Arcadia as well, a few of those different companies. Ultimately very wealthy, had a lot of potential tax to pay. But what he did here was he made sure that his wife was the shareholder. So he didn't really own too many shares himself. His wife owned the shares, and his wife was tax resident in Monaco. She was actually able to benefit from a £1.2 billion dividend. At the time of researching this, apparently it's the largest ever corporate dividend paid out to a single shareholder in the UK, 1.2 billion. And because of by virtue of her Monaco tax residency, there was no UK income tax to pay on that. So what he did here was quite clever. Well, he needed to be in the UK for this tax year, for example, because he needed to run the business, meet with the board, be in London. So actually he knew that he couldn't take this dividend himself. So I'd imagine what he did, the good thing about being married in the UK, well, actually there's provisions available when you transfer assets between spouses, no gain or loss. So he could simply say, you know what, Tina, I'm going to stay in the UK this year, but we've got a lot of cash sitting around, so I'm going to need you to take a dividend. So I'm going to transfer my shares to you, all above board, sign the paperwork. A legal transfer takes place. Next tax year, we're going to pay a 1.2 billion dividend out whilst you're selling it up in Monaco. You're only allowed in the UK 45, 90 days, whatever it might be. She's perfectly happy with that. She's got 1.2 billion tax free to enjoy. So I'm sure she spent a couple of $100 million of that. No problem, Phil. I can do that for you. And it might be a case where actually moving forward, the shares get transferred back to Phil. He can then take a dividend when he goes overseas back to Monaco. If the wife wants to go back to the UK, and you can structure it so that between you, as long as you're happy to spend a few months apart and whatnot, you can actually pay 0% income tax. And it's this type of tax planning that allowed Philip Green to actually have massive yachts. We're going to put a picture of it here, Philip Green's yacht, and ultimately things like that where you probably best off purchase it in your own name. But when you've got 1.2 billion of dividends coming through tax free, it's actually easy and straightforward to do that. So the wealthy, they plan for taxes, they live their life around taxes and wealth maximization. So if it means spending a year in Monaco to get 1.2 billion tax free, you can be sure that they'll do that. And then the last thing that they do, especially to reduce taxes, is they leverage assets. So a great example of this is Elon Musk looking to buy Twitter, now X. Basically he took out a massive loan against his Tesla stock. Basically, when you've got a valuable asset, whether that's property, stocks, gold, watches, cars, yachts, where you've got something that's valuable, you can be sure that somebody will lend you money secured against it. Whatever the kind of loan to value it is, if it's a yacht, you might get 60%. If it's stocks, you probably get 50 or 60% as well. But where you've got something that's valuable, someone will lend you money against it. And of course, if it's a solid blue chip asset, such as stocks or property, you can get very favorable rates and pretty good loan terms. And this is what a lot of wealthy people do, because usually they're income poor. more, because actually in the UK you pay a lot of income tax, up to 45% if you're just taking money straight out, whereas actually a lot of wealth is usually built in terms of capital events. So you sell a company, you pay capital gains tax at 24%. So for a lot of entrepreneurs, especially when we're talking 10 plus million, all the way up to the billions, this strategy applies for when we see it used, is they borrow against the shares in their company. As their company goes up in value, they'll go to JP Morgan, go to Goldman Sachs and say, hey, you know what, we could do with 100 million here. We've got a company that's worth 500 million, and they will look at it, do the deal appraisal, and then they could just lend you the 100 million. And the good thing about that is you'll have a very low interest rate, and then you'll know that actually in 5 or 10 years time, when it comes to selling the company, you might sell that company for a couple of billion, if we're talking numbers like that, in a couple of years time, and then you'll repay that loan, you benefit from the low capital gains tax rates, or even better, you move overseas and get the capital gain completely tax free. So this is what a lot of wealthy people do. They borrow against assets, because when you borrow money from a bank, it's not income, it's just a loan, even though it's secured on a capital asset. So there we have it, guys. Here's how the wealthy hide their wealth, and more importantly, how they minimize their taxes. A lot of this can apply to you, and certainly when it gets to a certain level, things like, moving overseas, borrowing against your company's shares, these are all strategies that you can implement in your playbook to build wealth and pay less tax. Make sure you smash that subscribe button and give this video a thumbs up. Bye for now, guys.